Hey guys, Freaky Finance here. Today we're going to talk about Yum China and Badger, two different companies again. I don't think I've done a video on either of these, so I'm going to do a deep dive on one of these at some point. Probably Badger. It's been on my hit list for a while. But anyway, we're going to jump into Yum China right now. So Yum China, it's an interesting company. Like I said, it's not a deep dive, so we're just going to go really quickly into it. But if you had to know what it is and how it makes most of its money, it's KFC in China. That's how it makes most of its money. It has a bunch of brands. The other reportable segment is Pizza Hut China, and you can see that here. KFC supposedly leading QSR in China based on system sales. Interesting enough, eh? Who knew? And then Pizza Hut supposedly the largest casual dining restaurant CDR brand in China in terms of system sales. No, they do say sales there instead of margin. And here, just like if you wanted to know what's important, it's KFC, and it stands out here. Like all their operating profit is basically from KFC. It dwarfs, like it's gigantic relative to Pizza Hut. Also, the margins at KFC are superior to Pizza Hut. They do have other segments, which I skipped over really quick. Right now, that's like smaller ones. So Lavazia, Little Sheep, Taco Bell. So less established brands are all in this one category here called all other segments. Not making money in that segment, so we can't really tell if Taco Bell's making money or one of the coffee ones are. But anyway, basically, for the purpose of today's video, is basically a KFC and Pizza Hut growth story. One of the things that happened, if we were to go Yum China, let's just go stock. It's up 8% today. I do own this one. It's one of the ones that got really crazy cheap during really the last 4 years in China have been crap, right, for anything Chinese, even if they were growing well. And China actually has started to inflect, and the business was like it was selling off into the inflection. So we were lucky enough to pick that up in the TFSA account. So up 57% after today. So it's no longer obviously mispriced. It's just, when something shoots up like that so quickly, it always usually my instinct is to take some off the table and cycle it to somewhere else, right? So that's probably what I'm going to look at today after I log off this video, is just contemplate whether I should just trim some now because it's gone up so much so quickly and cycle back in other things either in China or elsewhere. But so far it's been a pretty good trade. We didn't get the very low, but I never do. My average is 31.20 and it hit 28.50. So overall, though, still pretty low. And then Badger, the other one that we haven't talked about yet, I also own. And that one I'm actually down in. So down 11%. Not like every trade is a winner. Usually I'm trying to average into them as I get more and more comfortable with the name. What else is there? Let's just jump back into the numbers. So anyway, as for Q3, basically what's happening is to open more and more stores, and you slowly see more and more scale, specifically at KFC. We've also seen growth accelerate in terms of delivery sales, which actually at the time was reducing margin, and now it's starting to overcome that even. So we're starting to see double-digit EPS growth, or guiding to double-digit EPS growth still, as well as high single to double-digit system sales year over year. So you're getting potentially double-digit revenue and double-digit EPS growth at a time when the financial results had been relatively weak for so long in China. Now, some of the things that's pretty crazy is when you think about the profitability that's coming out of that. Like, imagine making 3 less percent sales, like same store sales, so SSG, but all your profitability metrics go up, which is pretty amazing, right? So you're getting higher margin on the operating line, you're getting higher margin after your SGA, and we're seeing that. And they started finally buying back shares. So one of the things that a lot of Chinese companies have finally done, it took them about 3 years, is they're starting to make more of a meaningful return to shareholder value for investors. So we've seen this with more positive dividend policies. We've seen this with more positive share buybacks. Basically, the Chinese companies are starting to take advantage of their very low valuations, especially relative to what's out there. Additionally, what a lot of the Chinese companies have done is they also have all invested in each other. So when they were all going down, they constantly had to market their investments, and that even put further pressure on accounting earnings. It didn't impact the operating earnings, obviously, But from if you look at like a PE multiple, if you didn't adjust for anything, it looked like they're still relatively not as cheap as they actually are or were. Now some of them have shot up, like this one has shot up 50%, but other ones have still kind of lingered. But part of that is just because they got so cheap for a bit there, and they might still again. You never know. But when I look at opportunities out there, you can't not have anything in China just because of how cheap they are, and that so far has worked out really well, right? But usually when something shoots up 50% really quickly, I usually will trim it just because usually there's something else out there that's not up 50%, right? Usually there's things like Dollar Tree or Dollar General or things that are approaching 52-week lows all the time, like CVS, that are kind of things that I want to look at, right? Or maybe Kohl's again. There's all these things that are there's always opportunities out there. Just the relative opportunity is something. Anyway, in terms of operations, revenue growth up 5, company restaurant sales up 5, so expenses up 5. So not a lot of favorability there in terms of economics of scale, but we are seeing the scale on the G&A line pretty good, right? So, and that's not just on the one quarter, that's on the 9 months too. You're seeing 15% less G&A expenses. So they're cutting costs very well while still growing the business overall. Which is interesting because same source sales growth wasn't even strong, which means they're able to cut G&A while barely seeing a slowdown in overall revenue growth. And I mean, it's far outpaced the slowdown that we've seen. And this is into a weak China, right? China hasn't been good for so long. So the fact that they're seeing top line growth while cutting so much cost out is nice, right? And we're finally seeing the buybacks here at the bottom. You can see weighted average shares outstanding 416 million. Now we're at 384. So part of the reason why EPS is shooting up isn't necessarily just all because of the business. It's also because of the buybacks have started up, which gets me excited. So that's what I look for. That's actually how it hit my scanner, is because I saw buybacks for the first time. I was like, what's Yum China? And I go into it, I'm like, okay, it's KFC. And I'm very simple like that. If I can shortcut things to make decisions quicker, I will. Anyway, what else is there? I mean, we see retainer is positive. Treasury stock's finally showing up. That's treasury stock's basically them buying back their shares. They finally started. I also like them China because it reports in US dollars, makes it easier for me. A lot of Chinese companies report in renminbi and then have a one column for US dollars, and then I'm like, I have to click too many clicks for Brian for freaky finance. What else is there? The balance sheet, there's not a lot going on, right? You don't have a lot of debt. You have 315 in short-term borrowings, and you have 1.4 billion in CCE with another little bit in equity investments, 388, which have started to finally increase as the stock market appears to finally bottomed in China, and that's after 3 years of them writing down investments in each other, which they all did. Balance sheet here, you can finally see repurchase of common shares finally showing up. They do pay a dividend, but it's very small, so it's more finally they're returning money to shareholders. And it does generate a decent amount of cash flow, right? There's a decent amount of depreciation here. This is on 9 months, so 1.2 billion in CFO. So kind of interesting. And you can see they funded the buybacks largely because they decided to mature some short-term investments and buy themselves back. That's why the cash on hand hasn't gone down, even though they bought so much of themselves in the last 9 months. When you look at the long-term trajectory, it is growing fairly well year over year. But we have seen EPS, it has gone from $1 to $2, but it's kind of been flat for like 3-4 years, right? And that's what we saw, is China's been basically in decline for 3 years. But now we're finally seeing it turn around. Like, we're starting to see buybacks at the same time we're seeing EPS growth go 22% net income year over year and 33% diluted EPS year over year. So we're starting to see an inflection on margin. At the same time, they're finally buying back themselves at a price that's still relatively cheap. So I like that setup. Anyway, I'll dig into Yum China maybe another day, but right now it's kind of more of my probably trim some of the win. Badger, we haven't done a video on this. I'm going to do a video on this at some point because I think it's a very interesting Canadian company, and I love tuck-in plays. Now, this isn't always a tuck-in play. It's basically a fragmented market, and Badger's one of the bigger guys in it. And they're getting more and more contracts from more and more bigger companies. It's starting to show up, and it's also a lot of scale. Um, Basically, it's a hydrovac play, an excavation play, and you can see that they have decent reporting. We've actually seen one of the reasons why the stock price hasn't done that great over, say, a 5-year period is very, very driven by government spending, in my opinion, and capex spending of corporations. And lately, usually right around an election, because of uncertainty, a lot of projects will be put on hold just to see who becomes the president, kind of thing. And this company has a lot of exposure to U.S. They've broke into the U.S. really strongly, and they continue to take share in a lot of markets, a lot of competitive markets. Partially, I think, because of their size, and because it's so fragmented. Like instead of like Badger here, for some context, hydrovac truck count 1,600 now, 1,500 the year before. But for some context, a lot of their competitors might only have 100 trucks, and then a lot of the there's a lot of mom and pop hydropacks that have like 4 trucks or 3 trucks or 2 trucks, right? And they're competing against these guys. And obviously, the scale when you have this type of network of trucks, specifically for a denser area, maybe you have some type of route mapping. It's just it's starting to show up in scale, like we're seeing it in them able to take price, seeing it so EBITDA margin, they're still taking price. And you're also seeing it in the G&A scale, which I'll show on a different slide. It looks really good. But we have seen weakness in Canada specifically, and that's put a dent in the growth trajectory of the EPS for this year. You have seen over time, though, you've seen the EBITDA margin just improve, like going from 13% to 18% to 22%. They're guiding between 25 and 30 by 2027. That's for their investor day. And for some context, they already hit 27.8 this quarter, but they are only at 23.4 on the 9 months. So basically, they're saying we're going to keep seeing margin expansion on the EBITDA line, and a part of that is the scale on the G&A and direct costs. So you're seeing G&A just go from 8.2% to 6%. They're guiding to 5 to 4.5. So I love seeing scale like this, especially at a fragmented market, because I've seen it before and I know it works. The trick is not overpaying for it. Obviously, the market knows it works because the multiple's never been cheap since this company's been public. But it's finally, we're starting to see improvement while the price is still horizontal, right? So that gets me excited, especially if I believe in this guidance. And so far, this trend has been happening, so it's not like they're not doing what they're saying. So we'll see if that's true. The main risk, and one of the main risks for me, is it really does depend on capex spend of so many different companies and utilities and governments, and it does affect things. So like you see utilities here are now 30% of the business, but construction is 47%. So if you have a slowdown in construction, you're going to have a slowdown at Badger. So it's going to be macro sensitive. You do have things like railroads and highways for transportation and industrial. You can see the bulk of it is construction utilities. But they keep winning share wherever they are, which tells you that they have a better product, or for whatever reason, a better sales team or something. They're doing something right in order to keep winning share over time. There isn't too much going on that I can get into in the financials for now. They do have some debt under the credit facility, $200 million. A lot of that, you have $5 million CCE and $192 in AR. So, and you do have quite a bit in PPE. So they do have quite a bit of trucks. And overall, though, you can see retained earnings just continues to tick up. So very profitable business, and it's only getting more profitable over time, both in terms of adjusted EBITDA margin, but also just the scale that you see on direct costs and G&A. So obviously there's still more scale that's embedded in the business as they continue to get bigger. And that's been the trend for some time. These are just the different segments again. Type of things that they deal with. So water treatment and sewage, right? Semiconductor manufacturing. So everything's connected, right? Bridge constructions, cargo volumes, trying to strengthen domestic supply chain, stuff like that. We have seen, despite the share price kind of just lingering around, we have seen revenue growth start to finally pick up again. But you can see Canada's down 12, US is up 10. So we're seeing a very different macroeconomic environments, and we have seen a weaker Canada relative to the US. So it kind of tells you how important the macro is to something like Badger. But over time, even with lackluster quarter in my mind, you're still seeing the EBITDA margin tick up, and that's going to be the most important thing to me, is seeing the margin still tick up over time, even with the top line currently slow down. And I think that's one of the reasons why we're getting an okay price relative to its average since it's went public, is because the growth rate slowed down. So the G slowed down, and we're finally getting some decent valuations to pick up something that has grown earnings fairly well as of late, and I think it can do it quicker once the economy isn't as bad in Canada, and if the economy holds in the States. But I do expect it to be very macro driven. So if the GDP starts slowing down even more in the States, then this is going to get cheaper. I think. What else is there? I did think I guess we could talk about politics since tomorrow's the election. But they did say, like, hey, how do you view basically if a Democrat gets in versus a Republican? Basically, they said if Democrats win, renewable projects like solar and wind could accelerate, benefiting Badger. Conversely, a Republican win might boost oil and gas projects. So you can see they're kind of hedging both. There's a lot of projects out there. So I don't know. It's kind of a hedged answer. I know a lot of people are trying to, which one's better for the stock market kind of thing, but honestly, markets hate uncertainty, so once the market's certain about who the president is, usually it doesn't matter in the long run. Usually you just zoom out. And you zoom out over a long enough time, you'll just see the markets go up. Very rarely do markets go down in a four-year presidency, let alone past that, right? You just zoom out, go 10 years, go 20 years. Stock markets go up, regardless of who's the figurehead. So that's just my opinion. And that's how I've made money over time, by not being emotionally charged to whoever is in power. Anyway, that's Yum China and Badger. Like I said, I'm going to do a better breakdown, I think, on Badger for sure, just because I think it could get interesting, especially if we see more of a slowdown. But I think right now you're getting a decent price because of growth had already slowed down. So, but that's just my opinion. Anyway, I'd like to know your thoughts on these two. They're interesting companies. If you have any other kind of like tuck-in plays or high-growth Canadian plays that are smaller cap, I'm always interested to flip them over and look through them. Badger was one I was like, oh, I think it was actually someone DM'd me on it, and I saw it, and I was like, yeah, this could be something special. So anyway, I'd like to know your thoughts, and have a great rest of your day.